Hello, welcome back. I want to get into our fifth of the series of 7 that we're working on, building an intrinsic value model of cash flows. I'm going to cover the general process. Actually, alongside this is I have Excel. There's obviously an Excel sheet behind this, other materials to make it a little bit easier to kind of work this out in Excel. I just want to kind of talk through the general process of what we're doing. And I will actually follow this up with a video that covers me actually working in Excel. I'll be pretty clunky and slow, but still talking about, the one additional repetition of kind of the practice of what we've been doing there. So calculating market cap, that's what I want to start with, the market value of equity. We could also do enterprise value. I'll finish with that if you're curious. I'm not sure this is going to be the cleanest way to make this appear, but it's the whole thing. I try to create one single slide to represent intrinsic value. I did this in Excel. If this is not totally clear, hopefully that's not a problem because I'm going to break it open. And that's what I want to do here. So I'm going to actually go back there. The first upper left quadrant of this thing is the financial drivers of cash flows, which I've talked extensively about. So this would really be just setting up our data. We're going to download our historical data. We want to kind of make sure we understand recurring and non-recurring. And then we're going to start to use, one thing I want to emphasize here, is use the existing financial statements so we can reduce the work or the work about work here. So I might do a little bit of changing, but not much. But I built this. The easiest way to do a valuation model is just to build it based on the available financial information, which are the balance sheet and the income statement. So instead of recreating it, instead of those adjustments to adjustments, which increase the chance we're going to make mistakes, let's just start with what's the way that companies present data? Oh, they give us income statements and balance sheets. Let's use those. Because, that's the driver of value anyway. Let's not overly complicate the process. So take their income statement, throw in the historical data. T would be the most recent period. T-1 is the year before that. The year before that is T-2. And then I just list out your revenues. If there's multiple lines, do that. If you need to add columns and rows, please do that. And then just kind of think about this as it's all of your expenses. All of your revenues and expenses. And then I have my balance sheet. Now, I clearly aggregated my balance sheet just for the point of the slide. But what are we going to do in our balance sheet? We're going to think about our operating assets and liabilities and just list it all out basically the same. And then the second column I have here where I have likely assumptions. That's getting us stepping a step towards determining what would our assumptions be for forecasting. Now, I'm not in any way in this discussion saying, what rate should we forecast revenue or what turnover should we have for certain asset items? I simply mean, what's a thing we would think about? We think about growth rates for revenue. We think about percent of revenue for operating expenses. Some items like operating income or gross margin are going to be straight calculations. Other ones like interest expense is not based on a percent of revenue. It's going to be based on likely our outstanding debt balance times the rate of debt. So each expense probably has either just a basic driver or our own personal input. So we would think about what would drive revenue. Why would we use a certain growth rate? Expenses, would they gain or lose economies of scale? Would they get greater efficiencies or worse efficiencies or something like that? Same kind of approach with the balance sheet. Again, not saying what you should do for each of these, but usually think about turnovers, which just means that the asset or the liability moves along with revenue. With after they achieve some sort of efficiency, I'll use inventory turnover here for a second. A company might improve its inventory turnover because it gets better at relationship with suppliers and understanding customer demand and assessing customer demand. But there's going to be a limit to that. They can't have inventory days of 1. That's not realistic. But maybe it's 22 days. They started at 26. They dropped it down to 22 as they improved and got better at some stuff. Great. But it's going to hit some point where it can't really change anymore. But what are you saying with inventory turnover? Given an expected level of revenue where you really want to spend your time is on your forecast of revenue, I would expect that if the inventory they turn inventory, 15 times during the year, I was trying to make my math roughly work. Then I would expect that they have a certain amount of, or I could expect they have a certain amount of days inventory outstanding. Those are the same thing. But basically that's saying that inventory or any other asset or liability, so I'm going to be all inclusive here, would move with revenue. As revenue moves, that balance on the balance sheet would move as well. All right, and I'll cover the other stuff later. We'd fill in our historical data. That should work. The next stage is actually what we'd add in here would be our forecasted period. In this case, I'm saying it's an initial period with 3 years. So I might actually have over those initial 3 years. I'm not saying it needs to be 3 years. I just did that for Excel. I would expect that like the revenue will grow at 12% or 15%, and I'll just keep that constant. Am I actually saying it'll literally grow at 12% during that time? No, but I am saying on average, I expect it to grow at around 12%. So technically, if it grows at, 14, 12, and 10, that would likely still be the same idea, mathematically speaking, not exactly, but generally speaking. All right. So what would I use to forecast that? Well, that's up to you. What's the company? And I'm obviously not using a real company here. What are their competition? What are the products they sell? Have they differentiated with their revenue? Have they diversified things? Do they have multiple lines of business? What has the historical data been? How would it be affected with economic conditions? Like whatever it is, you're trying to figure out what do they sell or provide to their customers, and what would my forecast be for revenue? And then the same thing with expenses. It's usually based on revenue. Do I expect efficiency, improvements, deterioration, et cetera? And then the same stuff trickles down. So all I'm adding in there on my green boxes is where I actually start to put my forecasted amounts. And then I have what? Just adding on to this, I could be doing, and commonly we do this in valuation. We don't just forecast like a certain set of years. We might have different periods. So I have initial period, first 3 years, secondary period, the next 3 years, and then my terminal period, which is going to be like the 2 years when they hit the steady state. You could make your initial period 5 years or 2 years or 1 year. You could make your secondary period 2 years or 5 years or 6 years. You could have a tertiary or third period before the terminal period. It's up to you, but I just want to emphasize that it's kind of one way to think about it is to think about this in periods. First, they're going to have like an initial period of high growth. Then they're going to have a secondary period of like moderate growth, but still greater than like a GDP level. And then in the terminal period, as I'll cover in a little bit, that's where you actually have the most constraints. The best way for me to say in the terminal period is it's not when we're trying to be creative, right? You got growth rates that are kind of limited to like overall GDP. You got you can't change. You're assuming in that period, like your efficiencies and your capital structure and your profitability is all kind of set. So the terminal period, just mathematically, what we're all saying is at one point the company will kind of hit this steady state and they'll stay there. So if you want to be creative and thoughtful, do that in your initial or your secondary, or even add in a tertiary period. But the terminal period is one where we just because we're going to use a perpetuity for the value of that, we want to make sure that we're not creative. We're pretty straightforward. And it's basically about keeping things constant. So you want to change things, please do. If you have reason to believe that revenue will explode in the next couple of years, throw that in. But like you can't have revenue that explodes indefinitely. You can't have constantly improving margins, because then it would go to like one point their net income is 100% of revenue. So like everything hits a limit. Revenue cannot grow at 15% indefinitely. It would take over the world, but it can grow for 30 or 40 or 60% for 2, 3, 5 years. It could grow at 150%, right? That's up to you to figure out. I just want to emphasize that, figure that stuff out in your initial, your secondary, maybe your tertiary, third period, and let things be kind of boring and non-creative in your terminal period. All right. And then I have here, this is a tough one to kind of see again, but I got an Excel that kind of covers all the stuff, and I'll make sure I post it with my students at least that they get it. Is that this actually goes back to what we talked about last lesson in lesson 4. You're doing the change in net working capital, the growth CapEx. Since we're doing a equity valuation, free cash flow to equity, we also need to include in the change in total net financial liabilities, as I write that out there. So this is going to give us our free cash flow to equity holders. And if you are my student, I'll make sure that with this video, you actually get this exact Excel file so that you can blow this up and make it bigger if this isn't the easiest thing to read right now. All right. Let me actually talk a little bit about this translation of cash flows. First, a step back to remind us of something. What are we doing in valuation? We're focusing on the core drivers of value, which is revenues and expenses. But technically, because we still count cash, so the scorekeeping of valuation is commonly done with cash flows. Now, that's not the driver of it. That's not where we spend our time, but we still technically need to do the little scorekeeping of cash flows. And I want to emphasize, the good news is if you've had a financial accounting class and you covered the statement of cash flows, it's actually virtually the same process. So think about it this way. And this would be more of how do I work out my net working capital, my total CapEx and those pieces, is that this is a slide I've actually used when I teach the intro level statement of cash flows. And it actually is kind of how we think about cash flows. In an intro level, no matter the background of the students, the most challenging part I've ever seen is that statement of cash flows. When I've done exams, what's the area where most students will get the most wrong? Anything about cash flows. The other stuff, they do decently well. You talk about revenues and expenses and assets and liabilities. And I'm not saying everybody gets it perfectly well, but like the percent of students getting that is much higher than it is cash flows, because there are adjustments and they're kind of non-intuitive adjustments that makes it a lot harder for us as humans. So similar idea I've kind of mentioned throughout this whole thing. But this is my version of like trying to distill the whole cash flow translation or adjustments down into like 4 core ideas. If we buy more items, assets, we'd have less cash. Right? So more of an asset translates to less cash. That's the mechanical adjustment we do with both the creation of the statement of cash flows and actually valuation as well. If we sell items, assets, we have more cash. So less of an asset translates to more cash. If we do not pay for things yet, we have a liability. We would save cash in the period, obviously not indefinitely, but more of a liability in that period translates to more cash in that period. And then the fourth one, and this is basically all cash flow adjustments are in here. When we pay for things we owe, liabilities, we would spend our cash. So less of a liability. When a liability goes down, it translates to less cash. So this is 2 things here actually that I'm knocking out. If you're ever just in an intro class trying to figure out how do I work out my statement of cash flows, it's these 4 core ideas. Don't skip, just get 2 of them. It's all 4. You can have assets go up and down, liabilities go up and down. It's why there needs to be 4. And this is the roadmap for translating things to cash flows, which is the same process we use when we translate assets and liabilities to cash flows when we're doing valuation. All right. Another small slide. I might have to redo this at some point. We'll see. Let me know if I do. It's just that I'm covering the rest of this, which is that we're not done technically with all those steps. We still have to figure out an appropriate discount rate for the cost of equity. We have to calculate the present value of each of those payments for each year. We have to calculate the terminal value using a perpetuity. I'm just listing these steps. I actually will cover these in more detail with the full Excel thing set up. And we have to calculate the present value, the terminal value. That actually somewhat goes back to my present value conversations that I did earlier in the second lesson here. And then we sum all that to get our market capitalization of the common stock. We can divide that by the estimated shares outstanding to get my value per share and compare that to the current stock price. Technically, I'll add this in here. If you're doing enterprise value, if that's what you needed, you could do this whole steps. You didn't have to change anything, except you do need to make one change at the end. I like it because it's one simple change. When you're done, if you determine the company's market cap, right, using this process that I've just covered, you're not done in determining enterprise value. You don't need to go back in and redo everything, but you do need to do one thing. You need to add the fair value of the debt as of the point that you're looking at to get enterprise value. So it'd be your market cap, everything we just kind of covered here somewhat quickly, and then you have to add in the fair value of the debt. That would be your enterprise value, assuming they'll have preferred stock and other stuff like that. All right. On that, I'm not going to go a deep dive in here, but I actually want to show you that in that Excel sheet that I created, I actually can do what I did was the free cash flow to equity, what I started with, and then enterprise value. I'll just highlight some differences. The point being that they both really have the same idea. There's a slight difference at the end, but not a meaningful one. So here, I would actually say, just to draw your attention to a few things, technically, the profitability metric or the measure of wealth in an enterprise value calculation is not net income. Net income is from the perspective of shareholders. It would be net operating profit after taxes, which is NOPAT, a net operating profit after taxes. And the difference between those two is net operating profit after taxes is going to include interest expense as a payout, or something that can go to our providers of capital or providers of debt capital. So if you're doing enterprise value, you can do the earlier step and add back the present value of the debt, or the fair value of the debt, or you could actually start this way. So what's like the core thing you want to think about with enterprise value? It's not net income. Net income is profitability for shareholders. It would be net operating profit after taxes, which is profitability for shareholders combined with debt holders or providers of debt capital. Right? Otherwise, it's virtually the same thing. Some slight adjustments in there. I'm not going to cover them all. Like the discount rate for enterprise value, you would use a weighted average cost of capital. You'd use just the cost of equity capital. Some other things here do matter. So it's not identical steps. But I actually want to go back to this for a second. The simpler way to actually get an enterprise value is just to do your estimate of market cap and then add back the fair value of the debt. Or you could do this process, get to the same end result. Again, I'm just emphasizing it's NOPAT. You're doing the same thing with thinking about drivers, focusing on revenues and expenses, using historical data, considering your projections. I mean, you're still spending all your time on revenues and expenses. It's just the adjustments at the end are a little bit different between enterprise value and market cap. And then there's my Same layout, same approach, same ideas. I'm not going to repeat them all. I'm just showing you that it's not a difference here in anything except kind of the, where do we start and some minor adjustments. Some differences there in those adjusting steps. We, for example, don't add back the change in net financial liabilities. We don't need that here. Same roadmap for translating things to cash flows. So please feel free to slow down as you need to. This is a little different, just to be clear. Mostly the same in terms of present value and stuff like that. The one last step's obviously different. If you needed the market, if you did focus on estimating your enterprise value and you needed the market cap, you would remove the present value of the debt from the present value of the fair value of the debt from enterprise value. So if you did enterprise value, you wanted to get market cap, you'd have to subtract off the present value of the debt, fair value of the debt. And if you did, it should be the same. I know I'm using them interchangeably. I apologize for that. They should be the same. It should be the same. Shouldn't be a difference. But you would still have to take enterprise value, subtract off the fair value of the debt to get to your market cap. All right. Similar idea. That's the whole thing there. I think I've covered that. I want to kind of talk a little bit about other things to consider as you're building your forecast. So you know your company, I don't, right? That's up for you to use this process, use this model, but you obviously have to apply it to your company. Start with revenue. Try to break it open always. Make that your default position. Products, services, different types of products, different business lines. I don't have that answer, but how do I break it open? Don't treat revenue as this just homogenous thing that appears. It's almost surely going to be segments, lines of business, products and services, something like that. Geographic regions, find the way to break revenue up, because I'm absolutely willing to bet there's no way that the factor that affects one thing of your revenue is going to affect all the things. Like what may affect services is going to be different. What may affect North America may be different from, Europe or Asia or whatever else. And don't assume it's all homogenous. So if you see like a net sales item reported on the income statement, which can be done, look for footnotes that break it open. Look for company-specific data to break it open, right? Then go to operating expenses. Your operating expenses are predominantly driven by revenue. So it's like, what's this expense as a percent of revenue? Do I expect like efficiencies or economy of scale? So then the expense should decrease as a percent of revenue if revenue is growing, to be clear, right? That's the idea of operating leverage. If revenue grows, the expense might be able to become a smaller part. Don't go crazy, right? I mean, just make sure that's a realistic thing. All your expenses can't go to zero. Just want to be clear about that. That's not an option. But you can say, hey, look, it's I don't have an answer specifics of this, but this item is at 12% of revenue, and if they grow, they should be able to drop it down to 9.5% for these reasons. Certainly allow those opportunities, or maybe you're going the other way. Look, we think that the increase in the price of supply and the lack of flexibility with respect to the customer's price sensitivity is going to enable them to have to pay more to suppliers, but not pass that on to customers. So I expect a compression of the margin where the item went from 62% of revenue, it's going to go up to 65 because of these incremental conditions or changes or whatever it is. You figure out your firm's specific facts to back that up, but that's where you want to spend your time in valuation. What do you expect revenue to grow once you break it open? And what do you expect operating expenses to do in relation to revenue? All right, consider operating assets and liabilities. As I mentioned before, with like my inventory turnover example, but do the same with accounts receivable, accounts payable, wages payable, whatever you see, link them to revenue. There's likely a relationship there. Determine financial assets, marketable securities, and financial liabilities. Just be aware of that. Some companies do have a large amount of financial assets. If they don't, I wouldn't expect that that's going to, be a part of their business, but it might. But, just be aware that not all of the assets on the balance sheet are operating assets. Inventory, property, plant, equipment, accounts receivable, those are operating assets, but they might have something like trading securities or marketable securities, long-term investments, whatever they end up calling it. Just, I would separate those. They're usually not related to revenue here. So then don't make that grows with revenue. Probably not. That's just, they have different reasons for it. Try to understand that. But that's one where I would say forecast, understand that stuff outside of the core business. Link those, whether it's like interest expense. What drives interest expense? It's not revenue. It's not revenue. Do not link that to revenue. It'd be based on how much debt do I expect? And then what's your cost of debt capital? So if I can use really simple numbers here, if I expect the debt to go from $100 to $200, and I'm saying that the cost of debt capital, I'm just using really easy numbers here, is 10%. Well, my interest expense is going to go from $10 to $20. And so that's where I'm going to drive that forecast. That's more of, what do I expect their debt to be? And then what's their cost of debt capital, and mathematically arrive at those two. So you're not estimating interest expense on your own. You're just saying, I'm estimating what I expect their needs for debt to be, and then I'm combining that with the cost of debt capital to get interest expense. You have to plug this. I'll cover this in Excel. I think that's an easier way to see it. You do have to have a plug to get your balance sheet to balance, which is, it sounds more complex, I think, than it is. It ultimately is just like, if they did all this stuff, where would the degree of flexibility come from? And good things to think about with plugging would need to be like debt or equity. If they wanted a certain amount of assets, they would probably have to raise incremental debt or equity. If I can again use simple numbers, if you forecast that the company is expecting or wants to have $100 of assets, and you're without changing liabilities yet, or with only changing operating liabilities, you're left with $90 of liabilities. So $100 of assets, $9 of liabilities. You'd say, well, how would they get those $100 of assets if their operating liabilities or their in the current state would only be 90? The answer is, well, they would just have to borrow or raise equity for the incremental 10. So then my plug is the debt or equity, saying, if I want to get to 100, and that's what I believe is realistic, and I would otherwise be at 90, how would I have gotten there? Well, I would have tapped debt or equity markets and increased it to get that extra $10. All right. Translate all that stuff to cash flows, as I've covered before. That's our general. That's like my roadmap, keeping it generic, not talking about specific companies. So spend your time on these at the first two, most importantly, revenues and operating expenses. But also, I want to be clear, be thoughtful, right? Don't make mistakes. Don't link interest expense to revenue, stuff like that with the rest of them. So you still want to be thoughtful and complete with the rest of your things. All right. Terminal value considerations. I mentioned this when I showed you the little chart in Excel, that in our terminal value, my comment was that you don't want to be creative anymore. So you're choosing horizon. Basically, you're choosing like, how long can I reasonably forecast the company performance? And the horizon is more of like, when do I expect them to be in the initial, secondary, tertiary period? The terminal period is like, when I just think they're going to be regular, steady state company. How would you determine that? Think about what information you have. What are the company's forward-looking plans? What are the conditions of the industry? How are they performing? Or more simply, try to think about like, how every company's going to hit this like steady state, but don't assume it happens quickly. I mean, just look at a Netflix or an Amazon or an Apple that like took quite a long time. You can be in a growth stage for decades, multiple decades. I just want to emphasize that point. Don't assume that after 3 years or 5 years, they're going to hit their steady state. Sure, that happens. That's going to happen. But that's not a blanket statement that you want to make. It's just that a company might be in a growth mode, heavy growth mode for 20 years, 25 years. That could happen as well. I don't want to say that I have a prediction with a probability attached to it, because I don't. So what do you want to think about there is like, what are they selling? What's their competition? What's their industry? What are the changes on the horizon? How long will they get there? And allow yourself to have changes in that initial, the secondary, and the tertiary period. Like, that's where you let things change from the current performance to the from like the historical to the forecasted. Like, you should be thinking about change. It's weird to forecast assuming exactly everything that happened in the past is going to recur, because you're saying change is impossible. Economic change, company change, strategic change. Even if the company's doing poorly, they usually know that. They're probably not run by idiots. So don't assume they could never change. If they're doing if they're doing really well, competition might come in. So like, just have a conversation that gets comfortable with, how can things change? How can things be different? Right. So that I think is where you want to use your imagination, not in making up numbers, but in like, wait, here's the status quo. The one thing that's constant is change. Allow myself to think about that, my group, whatever it is, for a meaningful amount of time. And then once I think I have a good reason that change will occur, put that in the initial, the secondary, the tertiary period. Unfortunately, I want to be clear, you shouldn't be putting the change in. You got to get your change out. Like, have that conversation, get it out, get it in your model in the initial, the secondary, the tertiary period. But it's not going to go into the terminal period. It'll be what drives you into the terminal period. But once you're in the terminal period, I want to cover this. It's when like you're not changing anymore. That's what the terminal period says. And this is not specific to this approach to valuation. This is more of a comment of using a perpetuity. Because we use a perpetuity with the terminal period, we're saying like at one point the company's going to hit this steady state. And the steady state, you expect all of the following, all five. People usually do the first one, but I want to make sure it's all five of these. And if not, you're going to be violating the opportunity to use a perpetuity. Sales, so all levels of sales grow at different rates. You are splitting them into geographic regions. Well, at this point, you're going to let them all grow at maybe global GDP. Margins are constant. So if you're going to argue the margins are going to get better between now and 10 years, fine. But once they're in the steady state, you're saying that like, the core profitability has been achieved. Turnover ratios are constant. You think they're inefficient with their fixed asset turnover, their accounts receivable turnover, something like that. Fine, okay. Change that in your initial or secondary periods. In the steady state, whatever it is, it's going to stay there. And that's going to be the idea, like you're going to hit a limit anyway. I don't know when they're going to hit a limit, and maybe you don't either, but try to make your estimate of like, look, they're going to gain some efficiencies, but they're going to basically tap out their efficiencies. Again, you can't have your inventory turnover. You could drop it from, let's say inventory days outstanding. You could drop it from 30 days to 26 days to 24 days or something like that. And great, good for you. You got more efficient. But you can't just keep bringing that down to zero or negative or whatever else, right? So, okay, you're going to have like just a meaningful amount of stuff on your shelves. And so there is a limit to all of these. And in the steady state terminal period, you're saying that literally is when, you have to be at a limit there, right? Financial leverage ratios are constant. If you believe they should change their capital structure, it's not going to make a massive difference on valuation. So I want to de-emphasize that as well. I mean, unless you're saying the company is just absurdly out of whack with their optimal capital structure. So if you're changing their capital structure, you are kind of saying the company is being run by complete idiots who don't know anything. I hesitate with that idea. I'm not saying capital structure can't change, but they might already kind of be closer to an optimal than we may expect, meaning the impact of that is going to be very minimal. But importantly, in the steady state, whatever that capital structure is going to stay constant. And then risk is constant. That one actually people usually do. You can't have like in your terminal period, you can't have 15 different discount rates. No, there's one. There's one that's going to stay the entire time. And actually, the reason why that matters is if you abide by all those things, then you can mathematically use a perpetuity. Technically, if you don't abide by all 5 of them, you really shouldn't be collapsing the thing into just the math of a perpetuity. So this comment here is more about like, when is it logical, reasonable to use a perpetuity? You actually need all those things to basically make sure that your payout is either constant and or constant, but growing at a certain rate. And you need all of them for that to be true, right? If you're changing your discount rate, you can't use a perpetuity. You need one discount rate in your perpetuity. If you're changing your growth rates across time or different business segments, you can't do that. And you can't use a perpetuity because you have one growth rate in your, and that would be the same with profitability, right? Your payout is going to be revenue minus expenses. So if your expenses are like changing in the terminal period, you're violating the basic idea of the perpetuity. All right. So when you hold all those together, you can use the perpetuity, as I mentioned there. They should all grow together. You can calculate the terminal value. As I have there, that's the specific math. The growth rate can be 0. That's fine. You could say, look, there's just no growth. They're going to kind of slowly go out of business, very slowly. The growth rate could be 2 or 3%, whatever else. This is another one where you want to make sure you have a constraint. You can't have a company that's growing significantly greater than GDP because then mathematically they would take over the world. If you believe that's the case, just say that this company's going to take over the world, and then I'll give you the answer. Go long. Right? If you're certain. If you're truly certain a company's going to take over the world and you're giving them a terminal value growth rate of 7%, why would you not go long in that company? They take over the world. Whatever they're at now is not the value of all companies. So that's your long. You don't even need to do the rest of it. And none of this matters. You just say, look, this company will take over the world, and therefore it's the only thing I'm going to invest in. The rest of valuation would be silly, or that maybe not be possible, right? Maybe they will just have a limit to the growth rate. So if you want to grow them, as I was mentioning in the early period, at 80%, 120%, because you have good reasons for it, go ahead. But you can't be using those kind of crazy high growth rates in your perpetuity or terminal period. All right. Practical tip. I kind of covered some of these. I want to be clear. I think I've actually got all these, so make sure you read them. Everything grows with revenue. And so in many ways, just want to mention here, all asset and liability growth revenue. In the terminal period, unlike our initial and secondary period, we're not actually doing, we don't really care about specific line items anymore. All of your assets and liabilities should grow together. So you don't really need to think it line by line. You're assuming that, hey, they're all going to grow with revenue. So keep it simple. You don't need to go line by line. In your initial or secondary period, you may want to go line by line and talk about efficiency, change, everything else. But when you hit the terminal period, you're just saying, look, everything grows at this rate. So I don't need to go through, my cash, my accounts receivable, my inventory, my other assets, they're all going to grow at the same rate by design because we're using a perpetuity. Capital structure is constant, discount rate cannot vary. Some of the stuff I've already talked about. Hopefully you're good on all that. All right, I got one more slide that we're going to wrap it up. So where should you spend your time if I can? I want to give templates certainly to my students to kind of help with a little bit of this process, but spend your time. This is your investment thesis on revenue forecast, operating expense forecast, the company specific parts, your discount rates, which I'll cover in a little bit. And then spend some time, but definitely don't go crazy on operating assets and liabilities. They're still driven by revenues and expenses. Estimating your capital expenditures, but that's really driven by your expectations of revenue. So if you expect them to have a high growth rate, they may need to be redeploying capital to get that. So I would say spend your time on your revenue growth rate and then ask yourself, okay, what CapEx or capital expenditures, growth CapEx would they need to achieve that revenue, right? So it's still, all this comes back to revenues and expenses. Obviously think about capital structure, but I would, put it in there, consider it, but that's likely not going to be a driver of value. And really won't be if you're assuming that their company's already near or at their optimal capital structure. And if you're saying they're not, you are saying that they're run by idiots. I would just hesitate with that idea. All right, that's it. That's this lesson. I'll jump on for a little bit more later. Take care.